Part 2 of how much money you need to afford a home in 2025. The first key piece of advice is the 30/30/3 rule, which is a practical guideline to help determine how much home is appropriate for you. The first part of the rule suggests that 30% of your gross income should go toward your mortgage, property taxes, and insurance. For example, if you earn $72,000 annually, your monthly housing payment should be capped at around $1,800. This would equate to a house in the $260,000 price range. For a higher income, say $150,000 a year, you could afford a house in the $550,000 range. Essentially, this rule helps ensure you don't take on more house than you can realistically afford. The second part of the 30/30/3 rule advises that you should have at least 30% of the property's value saved up in cash. This typically includes a 20% down payment on the house, which allows you to secure better terms and interest rates. The remaining 10% should be kept aside as a safety buffer for emergencies or market downturns. Saving up for this amount ensures that you're financially prepared for unexpected costs and market fluctuations. The third and final part of the rule is to never purchase a house that costs more than 3 times your annual income. So, if you make $75,000 a year, the maximum price of a home you should buy is $225,000. This rule is designed to keep you from overspending and getting into a financial strain. While these are solid strategies to use, lenders have their own criteria when determining how much you can borrow. Lenders mainly look at 2 things: your income and your debt. The key metric here is the debt-to-income ratio, which typically should not exceed 45%. This ratio helps lenders understand how much of your income is already tied up in monthly debt payments. For instance, if you make $8,000 a month and have debts totaling $3,600, you'd have around $2,300 available for a mortgage payment. With this leftover income, you could afford a home in the $335,000 range, assuming a 20% down payment. In terms of affordability, it's tempting to push for the maximum amount that lenders will approve, but the video warns against this. Even if you qualify for a loan that seems like a stretch, it's important to assess whether you can comfortably manage the monthly payments. Just because you're approved for a large loan doesn't mean it's the right financial move for you. Another important factor discussed is whether buying a home is the best option for you at this time. Given the current state of the market, where renting is often cheaper than buying, many people might find it more economical to rent rather than own a home. For example, a mortgage payment on a $500,000 house could end up costing significantly more than renting a similar property. The video highlights that, especially with high interest rates and home prices, renting might be the better financial choice in some cases. However, the long-term benefits of buying a home are also considered. For one, owning a home builds equity over time, and while it may not be the most affordable in the short term, it can pay off in the long run. Another key advantage is the stability of knowing your monthly mortgage payments won't fluctuate like rent might, especially as rent prices rise.